Good evening, everybody. It's great to have you here today for this session on fund of funds. Yesterday, Prime Minister Modi talked about Atmanirbhar Bharat, and today our Finance Minister has also repeated that we need to ensure that especially our middle class and low income segments become self-reliant. In that context, financial self-reliance becomes a prerequisite, and we believe that fund of funds are a timely solution in that regard. So in the next 15 minutes, I'm going to address a few key questions, namely, how can India transition from being a nation of savers to investors? Can asset allocation help in that regard? And why is it still an evergreen challenge? Can fund of funds be the solution that helps us obtain stable alpha and solve this pain point? At ABSL AMC, how are we differentiating ourselves in managing our fund of funds? And lastly, why one should consider investing in our asset allocator fund of fund? So as we all know, India is a nation of savers rather than investors. A case in point is that if you look at the total household assets in the country, more than 15% is still in bank FDs and 3% is in cash, and less than 5% is invested in equities. So the question is, how can we transition to become investors? And the answer to that question is quite simple. If we can get FD plus 2 to 3% returns over the medium to long term, but with lower volatility, then I as an investor will be happy to move my funds from bank FDs to an investment product. But let's look at the data to see if providing those kinds of returns is really that easy. So if you look at the last 15 years, the average inflation in India has been between 4 to 5% over 5, 10 and 15-year periods. And if you look at the pre-tax returns of different asset classes, we see that bank FDs have given between 7 to 8% pre-tax returns. So after tax, they're barely beating inflation. And now the FD rate has come down also. The fixed income category typically gives between half to 1% rate more than the bank FDs, and the PPF gives 1 to 1.5%. So there are okay returns, but still not attractive enough. The equities has done reasonably well over the long term and has been amongst the best performing asset class. But in the near to medium term, because of the downturn in the last 2 years, the returns are not looking that attractive. Similarly, gold actually hadn't done well over the long term, but because of the sharp up move for the last year, the returns are looking good, but they may or may not be sustainable. And lastly, real estate, which was one of the favorite asset classes in India, actually hasn't really given that good returns over the past 7 to 8 years. So what we can say is that the individual asset class returns can vary over time. And maybe asset allocation is a potential solution which can help us to get stable alpha because of the negative correlation between asset classes. So what do we mean by that? So if you look at the major asset classes like equities, fixed income, gold, and international, and look at the annual returns of the past decade, we'll see there's a lot of variation. And that's why asset allocation becomes an evergreen challenge. So the problem is that, the market cycles are becoming shorter from 7 to 8 years earlier to 3 to 4 years now. The historical correlations between different asset classes are also becoming diluted. And in addition to equity and debt, gold and international equities are also emerging as viable investment opportunities. And on top of that, the predictability of these asset class performance is becoming difficult. So if we see 1 year equities, domestic equities does well, the next year maybe gold does well, the third year international does well, but we can't be sure that the year after that the same asset class will do well. And then investors also have other considerations like taxation based on their holding period or exit loads, which are essentially switching costs, right? So asset allocation is becoming tougher to manage, especially in the shorter time frame. And how important is asset allocation really? So there have been multiple studies in this regard. And what has been found is that if we look at the portfolio performance over time, then almost 90% of the variability of a portfolio versus the market can be explained by asset allocation. And less than 10% is because of individual security selection and timing. So clearly investors need to get a handle on their asset allocation because it is a key determinant of portfolio performance variability over time. And even if you cross that hurdle, it's not the end of the road because after that we have to do the fund selection. So now there are thousands of funds and ETFs across multiple categories. So let's say as an investor, I manage to choose what I think are the best performing funds. I have to monitor and track the performance over time. I have to regularly decide whether to continue with some of them or change my portfolio. I have to be aware of the tax implications of making any changes. And lastly, I have to do a lot of reconciliation across multiple mutual fund statements and bank account statements, right? So both the life of the investor as well as the advisor is not easy. So we believe that fund of funds is an ideal solution which not only solves the pain points of asset allocation and fund selection, but can also help to make life easier for both investors and their financial advisors. So what exactly is a fund of fund? It's a very simple concept. I, as an investor, can invest in a fund of fund, and the fund of fund will then invest, for example, in equity mutual funds and ETFs, or debt mutual funds, or gold ETFs and international ETFs. So the objective is to generate capital appreciation through the diversified investment styles of the underlying schemes, while at the same time reducing overall volatility because of the negative correlation between the asset classes. So let's look at some of the specific benefits both for investors and advisors. The first is affordability. Like I said, this solution is especially valuable for the middle class and lower income segment because we can start SIPs with as low as 500 rupees a month in a fund of fund and still get exposure to the diversified investment styles of the underlying schemes. Second, professional management. There's a dedicated portfolio manager who runs the fund of funds. So he takes a call on which funds to invest in, regularly tracks the performance, and makes changes in the portfolio to rebalance it. So the chances are higher that investors will get a better risk-adjusted return over time versus they're doing this themselves. The third is significant cost savings. Typically, when investors do any changes in their portfolio, there are tax implications with regards to capital gains. But because the fund of fund is a mutual fund, there are no capital gains taxes, and it can rebalance the portfolio without these considerations. So that's a benefit for the investors. Now, one point is that the fund of funds are taxed like debt, so 20% tax with a 3-year indexation benefit. But given that equities also have a 10% long-term capital gains, if investors come in with a 3-year horizon, then the end taxation is almost similar to equities. The next point is on lower volatility. Like I mentioned, the performance is less volatile because of the negative correlation between asset classes. And lastly, convenience. So there's only one fund of fund, so investors only need to look at the statement of that fund of funds. So there's less documentation and less time needed. So we believe that fund of funds can simplify the life of both the investors and as well as the advisors, especially for financial advisors. We can say that they can focus more on the client management and let the fund of fund manager focus more on the investment management. Now at Aditya Birla Sun Life Mutual Fund, our product is the asset allocator fund of fund, and one of the key differentiators for us is that it's a very flexible product. So we invest in 4 major asset classes: domestic equities, international equities, debt, and gold. In domestic equities, the focus is more on having large caps and multi caps as a core part of the portfolio, but we also invest in thematic and sectoral funds and sometimes mid cap and small cap funds. And we can invest between 20 to 80% in domestic equities. International equities is mainly index ETFs in the US, Europe, and other emerging markets, and we can invest between 0 to 15% in that. In debt, the core of the portfolio will mainly be corporate bond funds and banking and PSU debt funds, and we aim to invest 25 to 75% in that. And lastly, in gold, we invest in the gold ETFs, and we can invest between 5 to 15%. So the idea is that domestic equities and international equities give exposure to growth, whereas the debt and gold provide stability and liquidity to the portfolio. The next differentiator for us is the comprehensive process we follow, both in terms of the top-down asset allocation as well as the bottom-up fund selection. So there is a dedicated FOF portfolio manager who takes inputs from both equity fund managers as well as sector analysts, and also the debt fund managers and our in-house economists. So every month we have a formal review process where we develop our own view on the markets and the economy and which asset classes may do well. And based on that, we try to take a call on the asset allocation. In addition to that, we also have an in-house quant model, which looks at various metrics and gives us a signal in terms of the optimal asset allocation between, for example, equity, debt, gold, etc. So that is also an input into the decision making. And lastly, we have another model which looks at all the mutual funds in the industry and ranks them based on the historical risk-adjusted performance. So we can also see some trends in the different fund categories and how funds are performing, which helps in the bottom-up fund selection. So as an example, these are some of the metrics that we look at in our asset allocation model. Mainly valuation metrics like price to earnings ratios, price to book ratios, interest rates, as well as market cap with GDP and so on. And an interesting thing that happened was that in the middle of March, in our fund of fund, we had around less than 50% allocation to equities, and we saw a sharp fall in the markets. So at that time, our model gave us a signal that we should increase our equity component, and based on that, we increased the equity allocation to 75%. And subsequently, we saw a sharp rally in the equity markets in April, and that has helped the fund performance. So we believe that we have a good asset allocation model. We've also done the backtesting of the model, and we have got some good insights. In terms of the bottom-up fund selection, like I mentioned, we have a model that looks at the historical risk-adjusted returns for all the funds across various categories. And for example, that can give us a signal in terms of either having a tilt to large caps or multi-caps, or mid and small caps, or to some thematic and sectoral. So for example, currently we have a larger tilt to large caps and multi-caps in the portfolio. Another aspect is that, as you know, fund managers are different styles. Like, somebody might be focused on growth or value or quality or momentum. So we try and understand the manager styles and have a fair mix of different styles in our portfolio. So what does our current portfolio look like? So like I said, valuations were attractive. So our model gave us a signal to increase the equity component. So the equity allocation is close to 75%, and debt, gold, and cash is the remaining 25%. In equity, the allocation is more to large caps and multi caps. And we have some thematics, for example, the pharma and healthcare fund, which has done quite well over the past month, as well as the consumption-oriented Gen X fund, which has held up reasonably well, even in this volatile environment. In debt, like I said, the focus is more on the corporate bond fund and banking and PSU debt fund. And we also have a 9% allocation to gold ETFs to provide a hedge in this current uncertain environment. Now, the next question investors will have is, okay, so with this, what kind of performance have we obtained? So before going to that, I'd just like you to narrate a short analogy. So once Rahul Dravid, the famous batsman, was going into bat, and he had a look at intense concentration on his face. And one of the TV commentators asked him, "Oh, it looks like you're thinking of whether you will score a century or a double century in this match, right?" And Dravid said, "No, actually, I'm thinking that how I should not get out on the first ball. And if that works, then I'll think, okay, how I can score my first run. And if that happens, then how I can score 10 runs, 25 runs, and so on." So in the same way, as investors, if our focus is on getting FD plus 2 to 3 kind of returns with low volatility, then it's important for us that the first step should be to not lose our wicket. And what does that mean? For an investor, not losing a wicket means not getting negative returns. So if we look at the fund of fund performance, as we all know, last year has been very volatile. Most equity funds have given negative returns, and even some of the debt funds have also given negative returns. But if you see the 1 year performance, our ABSL asset allocator fund of fund is flat. So it has not lost any money of the investors. And even the benchmark, for example, has lost 1.5%. If you look at the volatility of the asset allocator fund of fund is lower than, for example, the multi-cap category or the headline indices. So it scores on that front also. And if we compare the performance versus other dynamic allocation funds across various time frames, our asset allocator fund of fund has been consistently in the first or second quartile, not just in the short term, but in 3, 5 year and 7 year time frames. So we believe that we have a fairly good model that works and we can handle different circumstances in the market. So to summarize, why one should consider seriously investing in the ABSL asset allocator fund of fund. First point, like I mentioned, active asset allocation by a dedicated portfolio manager. It gives investors diversification across the key asset class categories such as equities, international, debt, and gold. There is an in-house model to aid in decision-making both for the top-down asset allocation as well as the bottom-up fund selection. We have a formal review process, regular monitoring, along with periodic rebalancing. Hence, we think that our asset allocator fund of fund is like the Rahul Dravid in the investing world. It can give FD plus 2-3% kind of returns with lower volatility. And hence, I would encourage you to look at the ABSL asset allocator fund of fund during the next investment decision. Thank you, and over to you, Sumit.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.